Hello traders, welcome back to Nova channel. And in today's video, I will introduce to you the cup and handle pattern. Let's get started. The cup and handle pattern is a bullish continuation pattern used in the technical analysis of a financial market. It resembles the shape of a teacup on a price chart. The cup portions of the pattern typically appears at a U shape, while the handle appears at a shallow consolidation period. In a sense, the cup represents a large period of consolidation, while the handle represents a smaller consolidation prior to the continuation of the uptrend. This pattern usually develops over a trading range that spans several days, weeks, or even months, sometimes extending beyond a year, making it one of the longest forming chart patterns out there. Traders often use this technical chart pattern to identify bullish signals in stocks, securities, or crypto markets and take long positions. This tutorial explains everything you need to know about a cup and a handle pattern and how you trade it, regardless of your trading experience. And now let's move to the next part. I will show you how to identify the cup and handle pattern. Identifying this pattern on the charts is typically a straightforward process as a pattern develops in three distinct phases. Here's the simplified guide to help you recognize this pattern quickly. In the first phase, let's spot the cup. The cup forms at the U-shaped formations after a price increase. It begins with a gradual price drop, bottoms out, and rises back. There should be a balance and symmetry with an even curvature on both sides of the cup. The right side of the cup should be close in the price to the left side, indicating that the stable market in the consolidation phase of the prevailing uptrend. And the phase 2, find the handle. The handle pattern occurs at the second stage of the cup and handle pattern. The handle patterns are an additional base in the price consolidation after retesting the previous high during the cup formation. The handle should appear as the smaller, shallower version of the cup, often resembling a bull flag or a bull pendant pattern. Ideally, the handle should be about a third of the size of the cup and should not drop significantly, shaping in the upper third of the cup. This phase is crucial as it represents the final testing area before the price breaks higher. And the last phase, phase 3, confirm the breakout. The third and final stage of the bullish continuation patterns is the breakout. This phase is signaled when the price breaks above the handle's upper trend line, surpassing the resistance level. This surge represents the culmination of building pressure from buyers, driving the price upward as the pattern completes. For traders, the breakout is an important buy signal, suggesting the pattern's resistance is clear and a rally will have further to travel. And now, I will show you the key rules for identifying a cup and handle pattern. To confirm that you have identified a cup and handle pattern correctly, here are some key rules to follow. First, ensure a previous uptrend. The cup and handle is a bullish continuation pattern, which means there needs to be a previous uptrend prior to the cup pattern developing. Look for a consistent series of higher highs and higher lows for the asset. If there was no prior trend, or if the prior trend was choppy, false signals may appear. And the second rule is the cup forms. You will notice the asset breaking is consistent series of higher highs and higher lows as a near-term top develops. This could be due to a broader choppy market or a broader market correction kicking off the cup portions of the chart pattern. The price declines to form the left side of the cup. A steady price decline is often preferred over a more abrupt and severe price decline. This steady decline shakes out weak holders who give up on the asset and do not anticipate a rebound anytime soon. The cup shape should be resemble the letter U, and you can also appear V-shaped. The depth of the cup should be between 1/3 to 2/3 of the pattern's previous uptrend, reflecting consolidation within a larger uptrend. Applying the Fibonacci retracement tool, the depth of the cup should run between the 38% to 61% retracement levels. The bottom of the cup should not consume more than 2/3 of the previous uptrend. If it does, is it considered too deep and may not be a reliable cup and handle. You can use the Fibonacci retracement tool to determine the cup depth. If the price retraces below the 61.8% Fibonacci level and resides there for a while while forming the cup, you may want to steer clear and reassess. And the third key rule of today's topic is cup duration. After finding support, The price bottoms and rallies to retest the previous high. Sometimes the right side of the cup and handle patterns reaches above the previous high or falls slightly short of the high. The key previous high or fall slightly. The key component is that the price rallied back close the previous high by the left side of the cup. This is followed by an increase in trading volume as the stock price recovered to its peak. The cup patterns typically spans 1 to 6 months. A longer formation period establishes a solid base for a potential breakout. And the next key point is handle the pattern forms. After using significant strength to rally back and retest the left side cup and handle high, a secondary base forms at the handle. The handle of the cup should ideally not dip below the 50% Fibonacci retracement level, should remain in the upper half of the cup height. Exceeding this range may indicate a weak pattern or a potential failure. For higher chances of success, aim for the handle to be above the 38.2% Fibonacci level of the cup's depth. Time duration of the handle is about 1/3 the length of time as the cup's duration. A shallower cup may lead to less time spent in the handle, indicating underlying strength. And the last key point of today's topic is breakout above resistance, the final confirmation. As the handle completes, prices will rally again to retest the handle and cup's resistance. A successful break of the handle could trigger a bullish entry. A successful breakout typically includes increased volume as buyers arrive in large number. Sometimes, after a breakout, the price may linger near the breakout point or circle back to retest the point of breakout. These occurrences are typically when the resistance breaks. The target price for cup and handle patterns is measured to move of the distance of the cup applied to the breakout of the handle pattern. These rules are not just about recognizing chart and pattern shapes. These are about understanding market psychology of the mass traders involved in the trading asset. And this is the lesson today. Thank you for watching and see you in the next video.